Well, this concludes Ken Moraif's latest excursion into the land of market timing. Retirement Planners of America, ARPOA, finally put the last sidelined 25% of cash back into the market. And when it was all said and done, assuming that they got back into mutual funds that settle at the closing price of the day, they locked in about another 15.87% in missed gains versus had you ARPOA clients just sat and did nothing, buy, hold, and do nothing. And this is the fifth time in a row that Money Matters, now rebranded as ARPOA, has locked in missed gains. And what really hurt you clients this time is that until August 8th, 75% of your money was still sitting on the sidelines, sitting as the market went straight up. And by the way, based on Moraif's prior market timing attempts, I previously estimated that Moraif's break-even point might be somewhere roughly around a 27.5% market drop. So if the stock market were to drop 27.5% from peak to bottom, you would estimate that the whole market timing attempt would be a wash, nothing gained and nothing lost, other than capital gains taxes. Well, during this coronavirus crash, the S&P dropped 33.79%, yet instead of you people saving about 6.25%, instead you people lost 15.87%. And since 2009, you clients have now lost out on a grand total of 102.33% in gains when including a 1.25% annual management fee. By the way, in my previous videos, I factored in just a 0.99% management fee, but I'm reading more and more that it's 1.25%. Or going back to 2007, which is before when Moraif saved you people from 29% of that 56% crash of 2008. That 29% in savings has now evaporated. You clients have now missed out on about 44.71% in gains. And these figures don't even account for taxes. Remember, when you pay taxes sooner than later, whatever dollar amount you pay in taxes no longer gets to grow and compound. But all these figures are based on various estimates and assumptions of mine. Pause the video if you like, because ARPOA is not GIBS compliant and they do not post publicly their performance numbers as far as I know. You know, with mutual funds, index funds, stocks, bonds, etc., all of their performance data and metrics is disclosed with full transparency. You want to know their 1 year, 3, 5, 10-year performance, any time frame you want to look at, their risk statistics, alpha, beta, R squared, Sharpe ratio, etc., for all to see, not veiled in secrecy. Yet with the ARPOA website and Moraif's radio infomercials, you're left to try to, I guess, search the internet and piece together his buy and sell points and then estimate his performance versus the benchmarks. But fortunately, I have been listening to his radio infomercials and have been tracking his performance for about the last 5 years. And I was also able to dig up public information on the internet to figure out his buy and sell points that predated when I started tracking his performance. By the way, I read an article on RIA Intel where they question why, when Moraif rebranded Money Matters as ARPOA and created a new website, they apparently did not upload old email alerts. And I guess information in those posts, those email alerts would include past market timing, sell and buy dates. So again, lack of transparency. But so what was Moraif's spokesperson's excuse when asked why they did this? They stated that essentially that giving out their past entry and exit points would allow other advisors to calculate their proprietary strategy. Then they could copy their market timing strategy. Like anyone would copy this strategy that has failed so badly over the last 11 years. Trust me, nobody is trying to copy this strategy. So this is a bogus argument. But even if you choose to believe this, do you see the dodge they did there? Like, okay, so you don't want to post the sell and buy dates. Fine. Then post your final tallies for each market timing call. It's so simple. How did you over or underperform the benchmarks for each market timing call? And then post that on your website and make it clearly accessible for the public to see. I have never, ever heard him announce how much he over or underperformed the market for each and every market timing call on his radio infomercial. Never. Even for his 2008 market timing call, he never provides the details of how much of that 56% crash he averted. Instead, for example, he might just selectively say that they were out for all of 2008 without telling people that when he got out in 2007, the market had already started to go down. And in 2009, when he got back in, the market had already started to go back up. So when it was all said and done, he only averted about 29% of that 56% drop. And that's when including his 1.25% annual management fee. By the way, if you're a client, have you ever asked for their complete performance data? And did they provide it? And if so, does it not match up pretty closely with my estimates? Post a comment in the comments section. I'll bet that 99% of you clients have never even asked. I hate to say it, but most investors are stupid. They believe that a good investment advisor times the market and beats the market. And as ill-conceived as that is, to top it off, they don't even ask for the advisor's track record. And here's a prime example, and an amusing one at that. This Yelp reviewer is upset that Arpoa did not send her an email to tell her to get out of the market before the coronavirus situation got worse. My dear, that's a good thing. You don't attempt to time the market. And if you had followed Arpoa's advice note for note, you would have lost 15.87%. And actually, it sounds to me like, I don't know, maybe she sold off her stocks after she was down $18,000. And if so, hey, great job. You did exactly like stereotypical naive investors do. Sell off all your stocks when they're down. Brilliant. Here's another Yelp reviewer dating back to before the company was rebranded. Again, someone who bought into this notion that your advisor is supposed to attempt to time the market. And that goes for you, the individual investor, too. Nobody should ever attempt to time market ups and downs with their money. And the reason is because everybody has access to the same news and information as everybody else. You're never going to get advance notice of a stock market crash or notice that a crash in progress is going to crash even further as opposed to ending and resuming going back up. By the way, talk about stopping on a dime and rocketing back up. Remember how dire the news was around March 23rd? The virus is going to kill 2.5 million Americans. We're going to be in a Great Depression. But that was it. That was the end. The S&P stopped on a dime and shot up 61%. Who could have predicted that? Same thing in late 2018, Moraif's previous market timing mishap. I mean, it was a slam dunk. The death cross, inverted yield curve, oil prices falling, growth in China slowing. Ray Dalio was predicting a 70% chance of a recession, and Moraif was saying big swings in the market almost always happen in bear markets. Blah, 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 blah. Never happened. The bull market resumed. By the way, Moraif also locked in 2% in missed gains for the bond portion of clients' money. As far as I know, this is the first time he got a sell signal to sell off the bond portion of clients' money. And this one, as far as I'm concerned, had failure written all over it because mutual fund managers who manage bond portfolios, these experts have a very high failure rate when it comes to beating the indexes. For example, when it comes to long-term government bond fund managers, 100% of them have failed to beat their benchmarks over the last 5 years. Attempting to time the market with bonds is an uphill battle, worse than trying to beat the market with stocks. And I have a theory as to why Moraif attempted to do this. He charges clients based on entire assets under management. So you can see how some clients would probably question, why should I be paying you to manage all of my portfolio when you have done nothing with regard to the bond portion of my portfolio? So by selling off bonds, it kind of makes it look like Moraif is doing something. I don't know. That's just my theory. By the way, if you're paying some advisor, any advisor, 1.25% per year, how much do you think it costs you after 14 years of fees? So I took out the management fee in my spreadsheet, and since 2007, your missed gains were reduced from 44.71% to 21.34%. That's half your missed gains right there, fees. But so after this last market timing mishap, I think Moraif's last remaining argument might be, well, if you're drawing income in retirement or you're going to be drawing income soon, you can't afford a really big market crash because you need your money to produce income for the rest of your life. And then he might use the hypothetical example of losing 50% of your money and then 4% withdrawals become 8% withdrawals. And that puts you behind the 8 ball at risk of running out of money. And putting aside the fact that to lose 50% of your nest egg in a stock market crash, you would be 100% in stocks and not own any bonds, which doesn't make any sense for a retiree. But putting that aside, does he have a legitimate argument with regard to if you're drawing income from your nest egg versus if you're just a young investor who is not taking income out of your nest egg? Does that foul up your retirement? As you know, Moraif averted 29% of that 56% crash from 2007 to 2009. But as we know, he has mistimed the market 5 times in a row since then. So I decided to look into something I haven't in my previous videos, which is to backtest his market timing performance when someone is taking out withdrawals in retirement. Did they fare any better than someone who has not been taking out income? And well, the answer is they actually did even worse. About 47% in missed gains versus only 44% in missed gains. So at this point, Moraif's only argument might be to say, yeah, well, we got it wrong over the last 1, 3, 5, 10, 12 years, but we still believe that moving forward, our strategy will work just because we believe. Or to just appeal to emotional investors who would lose sleep over experiencing a big stock market crash, but don't care if they miss out on gains that exceed what they saved by averting a crash, a net loss of money, but at least they feel good. I hate to say it, but there's a lot of irrational investors like that. People hate losing money more than they hate missing out on gains. It's psychology. And again, naive investors also believe that if they can just find a good advisor, a skilled advisor, that they will pick winning stocks, winning actively managed mutual funds, or successfully time the market.